In this video, I would like to talk about the differences between public and private markets in terms of their correlations. And that's based on something I noticed today. February and March were difficult months for public markets in terms of what I look at is traders and their results and investors, not necessarily markets as an index or broadly. And February and March were kind of hard months for traders. And it was also kind of tough months for private markets. And I'm not sure why. I mean, it's not like they're two different things. They're not connected. But there is some correlation. And in the case of private markets, it was a case that some deals didn't materialize for some small reasons. And sometimes it's hard to pin down on why that is. But it seemed like there was a noise that was prevalent throughout all deals, even the good deals. So deals were closed, but it was slow. But the deals that didn't close, there were some unusual reasons for them. Like a year ago, around this time, and maybe even like 2-3 years ago, since the market's been kind of quiet, the reason was just the volume was down. Investors were less active, and deals were not getting funded with the same amount that they were. A lot of money went to AI last few years. But what's happening now in the last couple months is a little bit of a different dynamic, and it seems to be correlated to public markets. So that's just an interesting thought, because we see at venture capital across lots of different types of deal flow. We see the institutional GP business, we see the platform flow, we see reports of companies raising money and IPOs, and we've got CoreWeave coming up, so it's kind of interesting. But I don't have a solution. I'm just observing the correlation in February and March that traders were having a tough time with markets. That can be because it was directionless or volatile or just a number of factors. And in the same time, in venture capital, private markets, there were some deals that didn't happen, and things that there was some fake news about some companies that were raising and they really weren't, and there was some other things, and a lot of noise in the market and not a lot of signal, more than usual, and just kind of not only noise, but I don't know, there was just some things to deal with, and it seems like now things are kind of back on track, so to speak. But that's just my 2 cents on markets, and we're always looking at private markets from a lens of public markets, because we're all familiar with public markets, and we're traders. I was a currency trader for 20 years, and I focused on FX, and I did trade stocks for a short time, but equities are such a tough market because it's a long story, but we all, I think, have a lot of experience with public markets, and not so much with private markets, and especially this idea that you can have liquidity in private markets, because there's really no liquidity because you have to have a pre-existing buyer. But it's interesting to note that sometimes, even though it's a completely unrelated animal, that there's a correlation there, and we can look at, is there also a correlation with things like real estate? Because a lot of times these things are connected. Like, for example, during COVID, when the Fed created this stimulus, real estate went up, stocks went up, everything went up. It just created inflation. It was just more money in the system, and it created tons of inflation. And if you have lots of wealth, inflation is good because you see your balance sheet growing. If you're a on the clock or a salaried worker, that's bad because there's almost never wage inflation. You're not getting a raise every month to meet the price of goods like eggs. So we're going to keep monitoring private markets for more developments on that level. We appreciate you. Have a great day.